All right, so Torsten, does this change your view? You've been one of the people really blowing the whistle when it comes to the inflationary impact of tariffs. Goldman out with the note saying that this court ruling, it reduces tariffs by about 6.7%. Do you agree with that estimate? Does it change your view on the inflationary impact of tariffs?
This is a significant change to the economic outlook if this persists, because the important thing here is that simulations from various institutions, the Yale Budget Lab, the Penn Wharton Budget Model, the Tax Foundation, they all show that tariffs, the way they were implemented, were going to lower GDP by roughly 1 percentage point for the next 3 quarters and increase inflation by roughly 1 percentage point for the next 3 quarters. So the consequence of that is that the stagflation scenario that has been worrying financial markets now for the last several months is now much less likely if this persists. Of course, it remains to be seen if other tariffs are coming or other tools are being used to impose tariffs. But the bottom line is that if we have less impact from tariffs, it will remove the stagflation scenario. And that's why it makes sense that rates are going up. And that's why it makes sense that the markets are rallying.
All right, so it makes sense to you. Torsten, I want to play a soundbite for you. Our colleague Megan Cassella actually spoke to the president yesterday. I'm just going to play the soundbite and get your reaction afterwards.
Mr. President, Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
I've never heard that. You mean because I reduced China from 145% that I set down to 100 and then down to another number? And I said you have to open up your whole country. And because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. Please, let's meet right now.
What's your take on what the president had to say? I think he's, pushing back against the idea that he's chickening out and more saying it's a negotiation.
So, of course, what happens next is most important for the outlook for the economy and for markets. So that's why what the response will be for the administration here to the court ruling is absolutely critical. If the administration does decide, of course, to say, okay, we're not going to do anything and we'll just leave it there, then obviously, again, we will go away from the stagflation scenario and we will have a scenario where the drag on the economy will be a lot less. And at the same time, also the upward pressure on inflation will be a lot less. So to that extent that this, of course, is something that changes the path, it does have important implications. That being said, of course, if the administration decides to go down other avenues of trying to impose tariffs using other sections of the law, of course, then that would have the implication that we would then have to read and understand what are the quantified implications for the economy and for earnings if tariffs come back, but just using different parts of the law.
And Torsten, just to clarify for the audience, the president does have other options to impose tariffs. For example, the section that he's using to do steel and aluminum tariffs, he could use something similar when it comes to other goods and imports and things like that. So that certainly is a market risk. When we initially talked, we talked about you coming on to look ahead to GDP. The second reading is expected to show contraction. I don't think that's going to change from this ruling, obviously, because it's backward looking. But the idea that we see tariff pauses, we see a pushback from courts on some of these tariffs, what do you think it means for GDP looking out for the rest of the year and the other quarters?
Yeah, this is a really important question, Frank, because we did have a negative print minus 0.3 in the first quarter. The key issue now is that uncertainty, of course, remains quite elevated about policy. Literally all measures of uncertainty that have been created both by Baker, Bloom and Davis and also by the Fed, they do show an elevated level of uncertainty, both for business planning and also for consumers at the moment. We did see some rebound in consumer confidence last week, but the bottom line to your question is it all depends on how consumer spending decisions respond to what's been happening here in the last 12 hours. And also what we're seeing, of course, on the CapEx side. CapEx plans by businesses have been reversing, meaning going down in the last several months. So it remains very interesting, and we need to watch very carefully how companies will respond. Do they feel that this lowers uncertainty? Then it will certainly be a boost to GDP, and then we should expect to see GDP higher over the coming quarters. But it really is now a matter of what does the high level of uncertainty we've had in place mean, and will that continue to be a drag on the economy and on spending decisions by businesses?
Well, Torsten, let's get down to it. Know what we know today. Again, court striking down the reciprocal tariffs, the White House saying they're going to appeal it, and we don't know how far that appeal is going to go. You sent us a chart, consensus expectations for inflation over the next coming quarters. It goes all the way out to November of 2025. According to this, core PCE, by the way, we get PCE tomorrow, is going to be above 3%. It's kind of hard to read right here, but it's the orange dotted line. Expect to be above 3%. Just knowing what you know today, is this still the scenario that you see playing out, or do you see inflation coming in softer by the end of the year?
Yeah, that's right, Frank, because this becomes really important for the Fed and therefore especially for rates markets. Because here the issue now becomes how are companies going to respond? Let's say that the tariff situation is going to mean that the level of tariffs is going to be lower. Then the question is, well, companies may already have purchased goods at the higher levels of tariffs. So that might mean that they may say, well, let's just raise prices because we just paid more for our imports. So that's why the trajectory that you saw in the chart there for inflation is still likely to the upside, because companies are now probably taking stock in terms of their pricing, in terms of what does this mean for what should the price of the goods and services that we're selling be. So the most likely scenario is that there's still probably some mild upside pressure on inflation, which is a problem when inflation already is 2.7 and we have been moving down. But now we are now unfortunately moving up, and that still complicates the Fed's job. That's why our bottom line to all this is that rates will remain higher for longer. That's what we're seeing in the front end this morning. That's what we're seeing in the long end. And when rates are higher for longer, that means that credit, especially private credit, yield levels will continue to remain attractive simply because of the upward pressure on inflation. The magnitude we can discuss, but if rates are higher for longer, it of course has important implications for asset allocation.
All right, Torsten, we really got to go, but very quickly, you said a mild increase. So do you still see it at 3% when we're talking core PCE by the end of the year, or is a mild increase keeping us below 3%?
Yeah, so here the SEP from the Fed itself is saying that inflation will be above 3%. The consensus also has inflation at 3.4. So taking everything into account that we know today, our forecast, we need to know, of course, exactly what's coming on tariffs, but our forecast would certainly be having inflation moving from the current 2.7 up towards 3%. So the answer is yes, Frank.